Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and things have improved a little bit since we started talking about the lack of conviction that the current market has with respect to internal metrics of the current bullish market. Um, but inflationary numbers came out here this morning, putting a little bit of a dent here in the current market rally. But so far, markets have not reacted too negatively. So let's review how we are looking at the equity and fixed income markets going forward. Before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off here with the equity indices and just how they're currently looking, which, like I said, are starting to improve a little bit. We'll also take into context the current inflation numbers that just came out here about half an hour ago. Then we'll take a look at the commodity markets as well as how interest rates are currently reacting here to the inflationary numbers, which I think will settle to some degree the debate that we've been having here over the past week as to whether inflation is more transitory or permanent. Then we'll take a look at the sector rotation data, some of the inflation numbers, and share with you our ideas here for today. But the primary, I would say, thing on most investors' mind for today is the inflationary numbers that just came out here this morning. A big part of trying to look at the debate that we've been having here over the past month or so. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my charts, my economic research, and just looking at how the markets are currently reacting to help inform our decisions here in the broader markets. So let's first take a look at the inflationary numbers. So the June month over month number came out to be 0.9%. Which puts us in terms of the year over year inflationary numbers at about 5.4%. So the estimate was about 0.5%, so came in substantially stronger than that month over month. The year over year number was expected to be about 5%, coming in about 5.4%. So both month over month and year over year numbers coming in fairly strong and fairly stronger than the market has anticipated. I would say that both equities and fixed income has reacted to this so far. We've seen bonds sell off, we've seen stocks sell off. The sell off hasn't been particularly violent or excessive, in my opinion. We've just seen a bit of a decline, but I would say markets have kind of found a little bit of support here around 435 on SPY. So we'll talk a little bit about that. And I think as markets digest these numbers, it probably, in my opinion, still settles the debate that inflation at the current moment is likely more transitory, as we've seen the interest rates over the past few weeks have effectively priced that in, because most of the gains in terms of inflation, a third of it was coming from used cars. We also see a fair amount of categories that are associated with reopening, such as hotel stays, car rentals, apparel, and airfares. So these are categories that are more likely to resolve themselves as things continue on here, as things reopen. So for those reasons, I think that's part of why the markets are not reacting too negatively to these numbers, and that based on the categories that inflation, based on these categories, markets are still expecting inflation to be a bit more transitory rather than permanent. So when we look at the equity markets, both SPY continues, the weekly and daily chart remains on its strong bullish trend here. That has not changed. We are trading near again towards the top of the channel here for both SPY. So we've seen a bit of a decline here today, but so far, the primary levels that we want to pay attention to here are 425 roughly or so. As long as we hold those levels, this is likely going to continue that move higher here. So when we look at SPY in both QQQ, they are certainly overbought, which means that just from a timing perspective, continuing to push long positions here in this particular market condition is not particularly favorable. Looking for more pullbacks here is certainly more desirable from a risk perspective. You have this double timing in QQQ as well as SPY. And then you look at the other major indices like small caps, IWM. IWM remains in this range bound range, but it continues to print higher lows. So this is an improving small cap indice, and while it has not broken out yet, certainly potentially has that upside. And if we see that breakout here, that confirmation helps us provide a little bit more confidence in the equity markets. But if we look at the Dow Jones, one of the indices that we referred to last week as not participating on the continuation higher here for equities. Well, the Dow Jones is just a few percentage, less than a percentage point away from breaking out to new all-time highs, which were formed here back in early May. So if we start to see the confirmation of Dow Jones Industrial, perhaps the Dow Jones Transports as well, continue to break out to new all-time highs, that does provide an improving condition for equity markets to continue higher. Now, the RSP was also another index that we refer to, the equal weight S&P 500 index. As the S&P 500 broke to new all-time highs, the equal weight index did not participate in that, meaning the broader S&P 500 names are not improving along with the mega cap names that are dragging this index higher. But again, RSP within just spitting distance now of breaking out to new all-time highs and confirming the breakout that we've seen so far in SPY. So both SPY and both the Dow Jones and the equal weight S&P 500 on the verge of potentially breaking out to new all-time highs and confirming and provide better support here for equities going forward. And when you look at domestic equities compared to emerging markets or international equities, this is really where we continue to see domestic U.S. equities be the stronger of the equity markets. We're nowhere near a breakout level here on EEM, certainly nowhere near the all-time highs that were put in back in February. So this is really, as you're looking across the globe, U.S. equities remains in its dominant position. So this means that we have strong relative strength from U.S. equities, and the fact that despite inflationary numbers coming out worse than expected here this morning, markets are still in a much better position here and likely to continue moving higher here despite internals that have not particularly looked strong here over the past few weeks. They are starting to improve. And then when you look at the 10-year yield, 135 was the level before the inflationary numbers came out here this morning. Right now we're inching closer to 140 basis points. So we may have found a bit of a temporary bottom here in interest rates around this 130 level. So we've established a bit of equilibrium around 160 a few months ago. We're now down to the 130, 140 level here. So let's see if interest rates kind of find a new equilibrium here around 140 basis points or so with the new inflationary data that came out here today. This decline here in yields is certainly challenging for certain industries like financials, which we'll talk about here in a second, in the sectors, but it certainly provides some stability for the equity markets that continue moving higher as interest rates have pulled back here and stabilized a little bit around this 140 basis point level or so. So having a pretty large influence here on equities and equity valuations, but the stabilization of rates, especially even in the inflationary environment that we're in, will provide further support here for equities to continue moving higher. And then when we look at the commodity markets, this is really where the commodities are starting to see some forms of, I would say, exhaustion. We see that the crude, despite the OPEC meeting failing to reach an agreement on production increases, crude has not moved higher here at all, showing some signs of exhaustion. So a lot of the commodities that could drive inflationary numbers even higher have started to see a bit of a plateau, have started to see some exhaustion, have seen the momentum slow down here. We've seen this in crude. We're also seeing it in gold after bouncing a little higher here, losing that momentum, no longer confirming a continuation higher here, and has even failed to fill this gap here around 171 or so. And even if we see a move up to 171, just that gap fill might see a bit of a rejection and seeing gold continue to trade sideways. So if you look at the long-term chart here for gold, it kind of remains in this downtrend that we've seen, even though it's kind of violated it a bit to the upside. It's right back into this channel. So we're really kind of back into this more downtrend here for gold and some of the commodities that we see. We've seen lumber pull back substantially. We see copper continue to trade sideways here. So a lot of the concerns around commodities continuing to move higher have started to ease a little bit here over the past week or so. And then when we look at the sector rotation model, this is one of the concerns that I have had with the equity rally that we've seen, because a lack of rotation suggests that equity markets are unhealthy, and a lack of rotation cannot last too long before the equity markets kind of have to correct that, if you will. So what we've seen here is three sectors: technology, discretionary, and healthcare, have been in the leading quadrant here for multiple weeks. And then we've had consumer staples, industrials, financials, and materials, utilities have been in the lagging category for multiple weeks now. But we have seen over the past week or so industrials, materials, and staples move into the improving category. Financials did as well, but starting to lose some ground here over the past couple of days. And then we do have both utilities and real estate making a pretty sizable move here towards the improving category. We really only have energy and communications that is still continuing to move towards the lagging category. So what we've seen is a improvement on the sector rotation model here over the past week or so. It's not quite where we would like it to be just yet, but certainly see a fair amount of rotation here from 9 out of the 11 sectors. And that is, again, constructive for the equity rally that we're starting to see continuing to build on itself. So when we look at the sectors themselves, a few that stand out. One is materials. Materials, after forming this triple top here at around $89 in May, has pulled back quite a bit from that $89 level all the way down to 80, which formed a bit of a double bottom here around the 100-day moving average. And just yesterday managed to break back above the 21-day moving average. And what this points us to is a bit of a shift here in this downtrend back into towards what could be that uptrend back towards that $89 triple top level here. So materials, having a bad month here in June, starting to see some pickup here in terms of trend back into the bullish trend, and breaking out here above this 21-day moving average is constructive for a potential continuation up to that $89 level. And then we have a very similar setup here in terms of industrials, but industrials actually a little stronger than materials. Industrials did not pull back below the 100-day moving average, but has managed to find this support level here around 102 or so, and is now likely to continue back towards this 106, 107 double top here that was formed, again, also similar to materials, back here in May. And especially when you think about the infrastructure bill that Biden is trying to pass, this puts it in conjunction with some support here for industrial names. And we'll take a look at some of those in our ideas section that could have a potential opportunity for further upside as industrials and materials continue to improve, and we're starting to see some decline from the leading sectors of discretionary technology and healthcare. And the only one that I want to point us to that is at risk here right now is financials. We've seen the improvement here in financials here over the past week or so, but this is a very big week for financials from an earnings perspective. And it's really important for us to also see how markets react this particular quarter. So this week is our first real glimpse at Q2 earnings and how markets are going to react to companies that beat on earnings, and how markets react to companies that miss on earnings. Now, financials are in a bit of a challenging position here with interest rates having declined, with the rate curve having to flattened, and we know that financials had set the expectation that trading revenues were going to decline, and that's exactly what we saw here from J.P. Morgan's report this morning. That trading revenues have declined substantially. That has been one of the major boosts to earnings for financials over the past year or so. So when we see that the trading revenues decline, in JP Morgan's case, they were able to offset much of the trading revenue decline in terms of iBanking fees, but not every bank is going to be in that position. So while JP Morgan and Morgan Stanley may have been able to offset some of their trading revenue declines with iBanking fees, not every bank's going to be in that position. So this is really where I think that when you look at XLF, this might be a bit of a range-bound motion here for XLF, and you might see some declines here, or more range-bound motion here for XLF, rather than the breakout that we're starting to see happen here on materials and industrials. So that's one that I think is worth paying attention to, especially in a big earnings week here for financials. So when we look at numbers, is really where I put this slide together here before the numbers came out here this morning. So we have an update now on the June numbers, which were about 9.9% in terms of month over month, and then year over year we're looking at about a 5.4% core inflation number. So slightly higher than markets were expecting, and as I said, equity markets reacting somewhat negatively initially, but so far giving back a lot of those losses here so far. As we look at SPY, it's now trading around 436 or so. Earlier today it was around 435, so it's given back about half of the losses here this morning. So this is telling me that equity markets, while concerned overall, once it digests the numbers, once it looked at different categories, so far shrugging off some of these inflationary concerns, like I said, mostly based on the categories. And also the commodity prices have started to plateau. This is part of the reasons why I think markets have priced in more transitory inflation, because we're not seeing the substantial increase in commodity prices we've seen here 2 months ago, such as with copper, with lumber. All of these have started to ease. It started to come down here, and the momentum has slowed down substantially on these commodity prices. So this is further evidence, I think, from the market's perspective, that inflation is more transitory, and that's why we haven't seen interest rates jump substantially here on this morning's numbers. So when we look for opportunities here in this market, this is really where we prefer using stocks that have strong stocks from a fundamental perspective, that have pulled back substantially and has formed this bottoming formation and is starting to break out higher here. A particular name that stands out here is Taiwan Semiconductors, one of the strongest semiconductor stocks, having pulled back substantially here from the February highs around $140 or so, all the way down to 108, forming this double bottom, forming this bottoming formation, and is now starting to break out higher here above this range. That is the potential opportunity that I see here with a stock like Taiwan Semiconductors, breaking out above this 120 level that has provided resistance for quite some time, and is now likely to continue higher here. As opposed to chasing stocks trading near all-time highs and starting to break out to all-time highs, the risk reward there just is not as favorable here. For a stock like Taiwan Semiconductors, going from 123 to 143 roughly, that's about a $20 move here to the upside. And if you see Taiwan Semiconductors back into this 112, 115 range, that would be time to cut your losses on this particular breakout. So you're risking at least, you're looking at about at least a 2-to-1 risk to reward ratio, potentially a 3-to-1 risk to reward ratio, depending on your entry price here. But those types of opportunities that I prefer looking for current market condition. And another one similar to this is John Deere. We've talked about industrials being one of the strongest sectors here at the moment. John Deere broke out here from this 320 level as The rest of the market was starting to peak here on February 15th, and we still see a lot of tech stocks trading well below the February 15th high. This is when John Deere really started to outperform here, breaking out above that 320 level, reached all the way up to 400, and recently pulled back to the 320 level and has found a bit of support and found some a base here. And this is really the opportunity here, now that it's found its base, to potentially break out back towards that $400 level. It hasn't broken out above its 100-day moving average yet, so you're still early, you're not late on this particular trade, and this is really the potential upside that I see when you look for the rotation that we're starting to see going into industrials, and the specific name that you can use to play for that rotation back into industrials. And then lastly, when you look at technology, a name like Team, breaking out recently above its $260 level here, finding some support after breaking out and kind of building a base here above this 260 level. That is the opportunity that I see, because we've pulled back to this 260 level, held as support. It's pulling back here again, and I think that is your opportunity here to the potential upside. And if we look at a longer term chart here for Team, it was range bound here between 210 and 260 pretty much since the late last year in October, right after the election. So after forming this 210 250 base, it's now broken out and it's pulled back to the breakout level, and that is the potential opportunity that I see here to the upside here as well. Again, risk to reward favors upside here because you're just near the support level. If we break below the support level, you would cut your losses within about $10 or so, but then you're looking at close to $50 in potential upside that projects up from the range between 210 and 260 to 310 here to the upside. So your risk reward ratio on this is closer to about 4-to-1 to 5 to 1, continuation higher here on a relatively strong and fundamentally sound technology stock. Looking for quality, in my opinion, in this particular market environment is my preference, as opposed to looking at those high beta tech, high growth tech names that may still have some downside, especially if we start to see interest rates rise, because this inflationary debate is still very much open from today's inflation numbers that we saw here this morning. So with that, that covers what I wanted to share with you here today. This is a very big earnings week, so it's very important that I think we spend the time here this week, not only evaluating the corporate earnings, which we do expect to be fairly strong, but more importantly, how stocks react to those corporate numbers. Because you could see a season where, despite expectations are very strong, stocks that even beat expectations may still trade lower. And so far, we're seeing stocks like JP Morgan here this morning have traded lower here on earnings. We also have seen, even though JP Morgan has given back some of those losses here this morning, Goldman Sachs trading a little higher after reporting earnings. Pepsi did have a pretty strong quarter here as well this morning. So we're starting to see some stocks react fairly strongly to the numbers this morning. So this is really where you want to pay attention to some of the names that are coming up with reporting earnings, and making sure that we're seeing stocks react positively to these numbers, because that's going to help us understand what the rest of the season is going to look like. So we'll talk about that here later this week on our Thursday webinar, which we will talk about the upcoming earnings season. But pay attention. It's going to be a volatile couple of weeks. You have some pretty big names reporting here over the next few weeks. So it's very, very important to pay attention to, and more importantly, understand how markets are reacting to these numbers. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday for our options education session for the upcoming earnings season. With that, thank you so much and have a great trading day.